Welcome to the Wealth Echelon, your ultimate destination for mastering personal finance, building wealth, and achieving financial freedom. Whether you're a beginner looking to budget smarter, an aspiring investor exploring the stock market, or someone seeking practical strategies for debt reduction, this channel is here to guide you every step of the way. Join us as we break down complex financial concepts into simple, actionable steps. Expect expert tips, proven strategies, and real-world examples to help you take control of your money and unlock your financial potential. Subscribe now and start your journey to financial mastery, one smart decision at a time. You've probably heard it before. Investing is only for the rich, or you need millions to make real money. But what if I told you that with as little as $1,000 or $2,000, you could start building a passive income stream of $5,000 per month? The truth is, most people miss out on this opportunity because they think it's too complex, too risky, or just unattainable. In this video, we'll break down those myths and show you how anyone can build wealth using the power of index funds. We'll dive into the challenges of traditional index fund investing, reveal a strategy to reach $5,000 in passive income with just a $2,000 one-time investment, and even show you how to hit your goal 10 years faster. Why index funds? Index funds have long been regarded as one of the best investment vehicles for building long-term wealth. They offer a simple, low-maintenance way to grow your money without the stress of actively managing individual stocks. Unlike actively managed funds that rely on stock picking and market timing, index funds passively track the performance of a specific market index, such as the S&P 500 or the NASDAQ 100. This means that rather than trying to beat the market, they aim to match its performance, historically yielding steady and reliable returns. One of the biggest advantages of index funds is their low cost. Actively managed funds often charge high fees for portfolio management, but index funds have minimal expense ratios, meaning investors get to keep more of their returns. The average expense ratio for an index fund is around 0.05% to 0.20%, compared to 0.50% to 1.50% for actively managed funds. Over time, these cost savings can significantly boost portfolio growth through compounding. Additionally, index funds provide broad market exposure, spreading your investment across hundreds or even thousands of companies. This diversification reduces risk, as losses from poorly performing stocks are offset by gains from others within the index. Historically, index funds have consistently outperformed most actively managed funds over the long term, making them an ideal choice for both beginners and seasoned investors. Another key advantage is their ability to provide consistent growth. The S&P 500, for example, has delivered an average annual return of approximately 10% over the past century. While short-term market fluctuations can cause temporary downturns, the long-term trend has been upward, making index funds a reliable option for wealth building. Investors who stay committed and reinvest their dividends benefit from compounding returns, significantly increasing their wealth over time. The big question, how much do you need? To determine how much you need to invest, start by asking, what are my monthly expenses for a comfortable lifestyle? How much investment capital is required to generate that amount in dividends? Let's say your goal is $5,000 per month. That's $60,000 per year. This is a common target for financial independence because it covers essentials like housing, groceries, transportation, and even some luxuries. Understanding dividend yields. Dividend yields play a crucial role in generating passive income from investments. A dividend yield represents the percentage of a stock's price paid to investors in the form of dividends annually. For example, if a stock is priced at $100 and pays an annual dividend of $3, its dividend yield is 3%. Dividends provide a steady income stream, making them attractive for investors seeking financial independence or supplementing their earnings. However, it's important to understand the balance between high and low dividend yields. Factors affecting dividend yields. Company stability. Established companies with strong cash flows often pay consistent dividends. Blue-chip stocks like Johnson & Johnson, Procter & Gamble, and Coca-Cola are known for their reliable dividend payouts. Industry trends. Some sectors, such as utilities and consumer staples, offer higher dividend yields due to their stable revenue streams, while technology and growth-focused industries may reinvest profits rather than paying dividends. Dividend growth versus high yield. Some companies prioritize steady dividend growth, increasing payouts over time. Others offer high initial yields but may lack sustainability. Market conditions. During economic downturns, companies may cut or suspend dividends to preserve cash, while strong economic periods often see increased payouts. Choosing the right dividend yield. A common mistake among new investors is chasing the highest dividend yield. While a 10% or 12% yield may seem attractive, it can sometimes indicate an underlying problem, such as a struggling company or an unsustainable payout ratio. Generally, a sustainable dividend yield falls between 2% and 6%, supported by strong earnings and a history of consistent payments. Compounding growth through dividend. Reinvestment. A major benefit of dividend investing is reinvesting payouts to buy more shares. Over time, this strategy significantly boosts portfolio value. For example, an investor who reinvests dividends in an index fund with an average 2.5% yield and 8% annual growth can see their investment double in roughly 9 years due to compounding effects. By selecting a mix of dividend-paying and growth-focused index funds, investors can enjoy a balance of steady income and long-term appreciation, accelerating their path to financial independence. The problem with traditional index funds. Many investors turn to the S&P 500 as a go-to index fund. While it's excellent for long-term growth, relying on it for income may not be the best strategy. For example, popular ETFs like SPY, VOO, and IVV track the S&P 500, but their average dividend yield is only about 1.24%. To generate $5,000 per month in dividends, you would need to invest around $5 million, an amount out of reach for most people. While the S&P 500 offers excellent long-term appreciation averaging 11.27% annual returns, it doesn't provide high immediate income. Over 30 years, your investment may grow significantly, but you'd likely need to sell assets rather than rely on dividends. A smarter approach. Higher yield index funds. Instead of focusing solely on S&P 500 ETFs, you can build a diversified portfolio with higher yield index funds to generate meaningful passive income. With just $2,000, you can construct a balanced portfolio that combines dividend income, higher yield funds that provide regular payouts, growth potential, funds that appreciate in value over time, stability, diversification across different sectors to minimize risk. For example, a portfolio offering a 2.44% dividend yield, higher than the S&P 500, can generate about $488 annually from a $2,000 investment. While this may seem small at first, consistent reinvestment and compounding can accelerate growth. The best index funds for income and growth. Here's a portfolio designed for both passive income and long-term appreciation. Fidelity Midcap Index Fund, FSMDX, 2.27% dividend yield with an 18.74% dividend growth rate. Fidelity Real Estate Index Fund, FSRNX, 5.88% dividend yield, providing immediate income. Direction Nasdaq 100 Equal Weighted Index Shares, QQQE, strong capital appreciation with an 11.28% annual growth rate. Vanguard Mega Cap Index Fund, ETF, MGC, exposure to large U.S. companies with stability. Fidelity Total Market Index Fund, FSKAX, broad market exposure with long-term gains. The power of compounding. Even if you start with just $2,000, the key is reinvesting dividends. Over time, reinvesting your earnings allows your portfolio to grow exponentially. Here's an example. Year 1, $488 in dividends. Year 5, reinvested dividends increase your holdings, boosting your payout. Year 10, dividend growth compounds, significantly increasing passive income. By consistently reinvesting, this portfolio can grow into a sustainable income stream over time, without requiring millions in upfront capital. Conclusion. Building a $5,000 monthly passive income stream isn't just for the wealthy. By strategically investing in high-yield and growth-focused index funds, even a small initial investment can grow into something significant. The secret is diversification, reinvestment, and patience. In the next section, we'll break down how to optimize your portfolio further and reach financial freedom even faster. Stay tuned. This version keeps your message intact but flows more smoothly while making it engaging and clear. Let me know if you want any refinements. Blast off. If you found this breakdown of how to earn $5,000 per month in passive income, even with just $2,000 to start, helpful, don't forget to smash that like button to support the channel.